Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to the Ideal Investor Show, where we bring you great guests who know stuff about money, know stuff about investing, and serve clients to deal with their money and make more out of it. And today we have a special guest to help us look at how he and his organization does that stuff. And that's Jonathan Blau. Welcome to the show.
Thank you. Pleasure to be here.
Yeah, thank you for making the time. So before we dive in and talk a little bit about the different things, and before we hit recording, we already talked how much importance it has to approach things with the right mindset and with the right state. But how did Jonathan end up doing what he's doing these days?
Yeah, I like this story. It evolved. My original exposure to investing on a professional level was as an intern at a firm called Lehman Brothers, which is no longer around. And
Yeah.
The summers of 1980, 86, and 87, I worked for some of the producers there. Got my exposure to the industry. And then after graduating from college, I worked as a stockbroker with Smith Barney, and that later became part of Citigroup. Once I did that, I decided I want to go back to graduate school so I could get my master's in tax, my MBA in accounting, and learn what wealthy families had to deal with from a technical perspective relating to their wealth, so I could become something more than a salesperson in the investment business. I joined a firm called Sanford Bernstein, which after leaving Arthur Andersen in 1996, I'm older than I realize sometimes. And when I joined the firm I joined, which was called Sanford Bernstein, they were the largest privately owned money management firm in the country. And I was 29 years old. And during the training, which was a 6-month training program, there was a day on what was called behavioral finance, which deals with how do we try to understand how people make decisions about money and uncertainty. Traditional economics always assume that we're perfectly rational when we make those decisions, and we only choose the options that will be giving us what's called the most utility, or in English, what that means is serving us the best always, making only those decisions. When in fact, what was proven by the people who founded the work in behavioral finance, a guy named Daniel Kahneman won the Nobel Prize for his work in 2002. What he found with judgment and decision making, that we're not just, he didn't just prove that we're not rational, but that we're almost making decisions about money and under uncertainty being completely irrational. And what he found that was more fascinating, predictably irrational. So we can actually know how people are going to choose based on our biases and so forth. And so what happened was, when I was with Sanford Bernstein, I started my career in the investment business in 1996. And from 96 to 2000, I built my business and I was all excited. And then 2000 comes along with the technology bubble bursting, the dot-com bubble, and the terrorist attacks soon thereafter, and the market lost 50% of its value. So that was my my indoctrination into clients being unhappy with investing in stocks. And then 2005, I rebuilt my practice, only to not have it decline 50%, but now 60% in the face of the decline during the financial crisis in 2008 and 9. And so what I learned is there had to be, what my epiphany was, there had to be an easier way to help clients and to run a smooth practice than to walk people off the same cliff emotionally that I walked them off 2 months ago, a month ago, a week ago, and yesterday. Again. And so that's when it hit me. I've got to do the lifeboat drill for them long before the bow of the boat touches the water. Have them prepared for what's ahead, so this way they can survive as investors long term and not always be reactionary to all of the many fads and fears that they're going to face over a lifetime. And that's when I adopted behavioral finance.
Very cool. That's a great story. So thanks for telling us. Now, helping people to understand, what to do when things don't go so well. How do they find you? I mean, I'm imagining, you mentioned 2000 and the bottom falling out and stuff like that. Are people just Googling and searching for services like yours?
No,
or how
that's
does
a
that
good
work?
question. Yeah, so typically our minimum investment is $5 million. And so those people typically aren't coming to us from the Google search. They're usually coming to us through friends who are already clients, or through, because I have an accounting background, I have relationships with a lot of accounting firms. So they'll come to us through their professional advisor through a referral. And that's how they find us. So what happens is when they come to us, we have to teach them to kind of unpackage all the baggage that they've been taught the wrong way before we even get started, in the sense of teaching them what we do the right way. And so what I mean by that is, in our industry, the investment advice industry, the belief is that we need to measure risk and safety in terms of protecting our principal. And not just so if I sold my business and I have $10 million, I don't need just to protect that principal from disappearing, which if I invest in a diversified portfolio like the Standard & Poor's 500, that's never happened ever in history. So that's not but even from fluctuating, and the industry calls that volatility, which are
Right.
just up and down movements around the long-term permanent uptrend. And so by telling us that that's our risk, that our risk is the movement from time to time of the number of dollars that we have, that by stock market exposure, right, volatility, that somehow I need to protect myself from that. And I call that the illusory risk. So when we now begin to say, well, so what is my risk? If my risk isn't that, Jonathan, what is it? The real risk needs to be measured not in terms of protecting my principal, but protecting what really causes me to run out of money in a 30-year retirement marked by 4% inflation, which is my purchasing power of every dollar.
Right.
And so what the industry does by misdefining risk and safety in terms of needing to control volatility, and the way they do that, the way they control volatility, is they tell you to have more bonds, fixed income, things that don't move around. The problem is if I buy a bond for 10 or 20 years, whatever the maturity is, every dollar I put in it is frozen for the next 10 or 20 years as inflation is going up 3 or 4% a year. So they're causing me to lose the value of every dollar, foisting on me the only real risk that there is, because of trying to address the illusory risk that there isn't, volatility.
Yeah,
And
no, I totally agree with that. I mean, as you know, we are helping our clients to invest in residential real estate, and they're not 5 million a person or a family or anything like that. But I think there are a couple of things that I would comment. For one, I totally agree with this aspect of volatility being falsely identified as risk. I also would add, as kind of like the cherry on the icing of that cake, that there is, in my opinion, a very clear effort to make the time horizon that people that invest in whatever, whether they invest in stocks or invest in real estate or invest in other assets, to try to make their time horizon shorter and shorter and shorter to be able to point to that risk. I like there is in one of the books that Jeff Bezos wrote, he said for Amazon, initially when we started, we knew that we will be measured by our performance, but where we really want to get to is that we wait for the weight, meaning like how heavy are we in the context of the business that we are conducting and how well we're actually doing it. And I have the impression, there's a whole industry now, I mean, on the media side, I'm not so much talking about you and me, but on the media side, that is really trying to take every little piece of news and at the latest, every 90 days when earnings come around, and make a big deal out of how horrible or how glorious a company suddenly is.
I
But the
agree with
longer,
you, but I think it's even far worse than that. It's not every 90 or so days, it's every 90 minutes. If you turn on CNBC, they talk multiple times a day this week about, well, is the Fed going to raise rates by
yeah.
June or July of this year? Will they lower rates? And in
Yeah,
terms
totally. Oh, but
of
that's exactly what I mean. Whether you
yeah,
take CNBC or any of the others and all the kind of other outlets that are out there from like Bloomberg and whoever you have. My point is more this extremely short-term volatility focused thing is just the wrong thing if you want to preserve that principle that you mentioned earlier. Now, like when we look in our case, we have the benefit that for our real estate investors, they have leverage. There is, from my perspective, oftentimes been this statement that when people put their money in baskets of stocks, then one of the other things that is basically eating away on their performance on the principal is this constant trading rather than being clear on what are you really interested in and invest in that. So when you're advising your clients, especially the wealthy clients, how much are you keeping them away from constantly jumping between 10,000 different mutual funds and stocks and
Yeah.
stuff like that?
Well, it's interesting. So there's a lot of behavioral issues you just hit on in the last few minutes. So I'll address some of them. There's help people to understand why it is that they react in the short run to all of these things. So it's all about human nature and how we're wired. But in terms of your direct question that you just asked before I get into that, when it comes to trading, right? So we have this illusion of control. We feel like if we have our hand in something, the outcome is going to come out better than if we don't have our hand in it. And it's kind of, there's also something called an action bias that we're all prone to. So if you ever see the person pressing the elevator button continuously thinking that's going to make it come more quickly, that's all part of our action bias. And it's the
Right.
same bias that causes people to trade and also has to do with the illusion of control. If we're doing something, we think the outcome is going to be better. One thing I've learned about investing a long time ago, and it's counter to everything we learn about almost everything else we try to achieve a goal with in life. If we work hard in school, we're told that we'll do well in life, career-wise and so forth. The harder you work, the better you do. Well,
Mm.
it's the opposite with investing. With investing, I found that there's little correlation between investment effort and investment outcomes. And the only correlation I found is negative. The more effort we try to put into it, the worse our outcomes usually are because we're tinkering way too much with the compounding by getting in and out of things all the time and the cost tax-wise and otherwise associated with that. The trading goes out the window. The best results that we think we can get intuitively, we think, well, if I can identify what the best investment is likely to be over the next 3 years with the highest returns, that's how I probably should try to invest my money. Not at all. You need to find the average returns that you can, the highest average returns that you're likely to be able to stick with for the longest period. Because
Right.
compounding is return, usually an average return, to the power of time, where time does all the heavy lifting. And that goes to the point of your first issue is we're all very short-term oriented. So what happens is from a behavioral standpoint, we have something called myopic loss aversion. It's like myopia. We can't see distance. So we're always focused on gains and losses in the short run. That's where our focus is. When you factor into that something called loss aversion bias, which it's proven that the pain of a loss to us is felt 2.5 times greater than the pleasure of a gain is felt pleasurable. So we're much more asymmetrically sensitive to engaging in strategies that minimize loss than that maximize gain. And then the third thing related to that is we're much more sensitive to the change in the value of what we own than to the actual value. So if I'm worth 10 million and tomorrow the market moves a little, so I see, yeah, my portfolio is 9.9, I don't think too much about it. But if someone says, hey, did you see you down 100,000 today? That change really rings a bell in my head. And I
Yeah.
say, oh my God, I'm down 100,000 in one day. What we do is rather than seeking out strategies that maximize our long-term wealth, we do the opposite. We seek out strategies that address those biases, that minimize the likelihood of short-term movement. And those strategies literally are the ones that minimize long-term wealth. So I want to overload in bonds because I'm afraid of who's going to be president and the election. And so I'm going to put all my money in bonds because that's going to minimize the short-term fluctuation that I think might happen. And the more often I do that, the more often I'm minimizing my long-term wealth because I'm interfering with the compounding and I'm adding more of the investments that reduce the growth of my portfolio at the same time that reduce the volatility.
Yeah, absolutely. I mean, what you just said earlier reminded me I'm originally from Germany, and so there weren't that many famous investors, but one guy who, in the early stages when the media started to pay attention to finances, which in Europe was, like pretty late compared to other
Right,
places,
right.
his name was Andrei Kostolany. I think he was originally Hungarian or something like that. And he said, kind of like translating what you just mentioned, the best strategy to invest is to commit to something that is average in the stock market. Just get a little basket,
Yep.
buy however you want to do it as long as it's average, and then take a 10-year sleeping pill. When you wake up, you will be super happy and you will not have gone through all the stuff that they have been discussing for 10 years. You couldn't care less. You just look at the result and you will be happy.
Well, that's it, and the more often people, there's been studies that show the more often people look at their money and their portfolios, the worse they do, because
Yeah.
by looking often, it's igniting that action bias. I got to do something. And with
Yeah, yeah.
investing, I always say the saying that we've heard over the years: don't see a problem, don't just stand there, do something. With investing,
Yeah,
I say it's the opposite. Don't just do something, stand there.
yeah, exactly. Which actually brings up the other question that I think is great to ask you, since you're doing the work. Besides I think the behavioral stuff. I mean, people obviously trust some of their money or all of their money to you. Is this last point you just made mitigated a little bit when somebody says, "Okay, I have it with Jonathan, and unless he tells me that there is something happening, I'm okay, and I don't have to pay
Yeah, that
attention
that
to it."
is a good question. That's how we train our clients. In other words, condition them. So when I
Yeah,
said initially, we do the lifeboat drill long before the bow touches the water. So for example, what does that drill look like? One of the things that I always try to teach people is I've learned a long time ago that surprise is the mother of panic. And so if you can help people to minimize the likelihood they're going to be surprised, then you minimize the chance that they're going to panic in the face of anything that they see.
right.
So what I teach them, for example, every year, believe it or not, according to JP Morgan's quarterly news item, they talk about how much the market goes down on average. The S&P 500 since 1980, it's gone down about 15% annually for any or no reason. Doesn't stay down, but that's the from top
Yeah.
to bottom fluctuation. And then twice that amount, about 33%, 1 year in 5 or 6, the average bear market. In the quarterly guide to markets, which is a great piece that JP Morgan puts out, they highlight all that. So I teach clients, if you're going to be an equity investor and you're going to succeed, you have to learn that you're going to see 15% of your money that you have in stocks appear to disappear each and every year. And you've got to look at that stoically. And you've got to continue your plan. If your plan is adding money every month, don't stop because it's down 15%. If anything, accelerate it because now you're buying things at a lower cost. And at the same time, 1 year in 5 or 6 you have to be prepared to watch about a third of your stock money appear to disappear and do nothing in response other than stay on your plan. And so once we teach them those things, that's exactly what you were pointing out. What happens is when those things happen, they know, Jonathan, I know you told me to expect this. This is what happens. I'm not going to react to it. I'm going to stay on my plan. And that's 95 or more percent of our client responses. Sometimes if it's a newer client, not yet, because they haven't
Right, right. Yeah.
become accustomed to it. But generally, that's what happens. And that's really our biggest value to investors is to address their behaviors. You know, investment performance falls into relative inconsequence when compared to behavioral investment biases and helping people to control those biases.
Yeah, absolutely. That's why I also think, and I'm sure you agree, that trust is so important. And it's a similar thing that is kind of growing over time. I mean, I can tell story after story about clients, and they came to us and they were originally joining our relatively small tribe because they were interested in the strategy and the approach that we're following.
Yep.
But then let's say they buy a property and 6 months into the property, there is a significant repair. It doesn't even matter what it is, right? And that
Right.
repair obviously impacts the cash flow. Suddenly, the appreciation is lost on them. The fact that they basically have depreciation that gives them tax benefits. The fact that the cash flow is only temporarily impacted. And that they typically can easily pay it out of reserves, and all those things that we discussed extensively to say what is the strategy besides just getting the asset.
Right.
There's a lot of nervousness, and it's exactly like you said, Jonathan.
From our perspective, we educate them about the behaviors, the 3 categories of flawed behaviors that cause them to make the mistakes. And this way, when they're aware of it, they're willing to hear our input as we remind them during the relationship. Hey, remember what I told you about the behavior that does this? This is what's happening now. We have to control that. We're there and helpful in that regard, rather than jumping the gun or listening to their neighbor or somebody who's really not giving them properly thought out advice.
Right. And see, I think the last two words you mentioned, properly thought out advice or thought out advice, I think that's the important thing to get across, right? It's not to say, call me and ask me, what should I do? But call me and say, I'm planning to do this. Can we talk about it and reflect on it and see if what I'm thinking makes sense for somebody who just hears about? Right.
Right.
I think there's a very distinct difference, and I hope for our audience, even if they don't have 5 or 6 million to give to Jonathan right now, That's kind of important advice is you should have somebody when it comes to your money and your investments, however big or small the amount is, where you can say, before I take the action, let's reflect on it with someone I trust.
That's right. And what's nice is try to place your trust in people with your kind of background, my kind of background, people who you think deserve to have your trust placed in them, not just because they're nice and smart, but because they have a certain skill set and process that makes sense to you. The principles we're talking about today apply to everybody, whether you have
Right,
500,000
right, exactly.
or 5 or 6 million. Behavior, one of the things that I've learned a long time ago, when it comes to behaviors and the things that we've talked about today, the human nature is immutable, right? So it
Absolutely.
doesn't change. That's the one thing AI is not going to change. If we go back, if I planted someone 500 years ago in a time machine or 500 years from now, and I put them down wherever they are, they wouldn't recognize the surroundings. What they'd quickly recognize as they observe people is they notice that people are responding to whatever the stimulus is that they're responding to with fear, with greed, with envy. That stuff never changes.
Absolutely. I'm totally with you on that. Now, before we close, I have something a little bit of a personal thing I wanted to ask you. And I'm asking this specifically because you said in your evolution to getting where you are today, you also did a lot of studying about accounting and tax and how especially wealthy
Yeah.
people have to basically deal with this whole issue of taxation. And I've never had a guest to be able to ask this, so that's why I want to take advantage of it. The media, especially the current administration and some of the people from that part of the political spectrum, for as long as I can remember, always make it sound like that people that the regular public would consider wealthy, and anybody can pick their number where how much asset
Yeah,
value
it's a
you have.
relative concept, right? It
Yeah,
is a
yeah, yeah,
relative.
right. But my point is more, we are fed this constant drumbeat of the wealthy do not pay their fair share. The wealthy are evading taxes. The wealthy are only wealthy because they have some tricks or they have Jonathans in the world or so forth. And if we just hire 80,000 more people or change the rules or increase the tax rate or stuff like that, then some way we're going to figure out how they have been successfully evading, and we will get them, and it will bring us 100 billion or 500 billion, whatever, pick a number. So I'm kind of curious. I have always said, if I were somebody who had 10 million or 100 million or stuff, I would hire myself somebody who does the taxes 100% in accordance of the letter of the law, because the potential loss or lawsuits and all that pain compared to the relative, in that case, relative cost to have somebody who really does it well is negligible. So for me, I want to ask you, is it really true that these people that have big number assets and stocks and companies and stuff, that they just know some tricks that nobody else knows, and if
Uh,
we get them, then get all this money that the IRS is not otherwise getting?
Sub parts of that question. So you can go into a lot of subparts. I could just answer this from my personal experience, right? Because I've been fortunate to build wealth by helping families protect and grow their own wealth.
Yeah.
And I also was unfortunate in that my father passed away when I was 13, and I didn't come from any wealthy family. So I put myself through undergraduate and 2 graduate degrees, came out even after getting a half scholarship with over 100,000 in student loans. And then what happened was I worked hard in a field that I felt was a noble field, because what we do for a living as behavioral investment counselors is we teach families not just today how to build their wealth, but if they follow these strategies, it can transcend life. In other words, the next generation and the next generation can continue to benefit from it. The way I look at it is I didn't have any secrets. I worked hard. I built wealth. What I had to do when I filed my taxes within all the boundaries of the law, every American citizen has the same ability to do what I did. So the fact to say that we're only wealthy because we evade taxes, that's tricky. No, I don't agree with that at all. I think it's a political talking point and it's a narrative. I mean, you could look at it a million different ways, right? You can say, well, what percentage does the average person pay to the government in taxes, whether they make 50,000 or 5 million? All I can say is I know that by the time I look at all my taxes, New York, federal, Social Security, I pay about 50%. And one of the things I always used to say is I have 3 degrees. I have an undergraduate in finance. I have an MBA in tax. I have a Master of Science in taxation and an MBA in accounting. So I looked at the curriculum, I say, of all my 3 degrees, and I looked and I studied hard to find which of those degrees in combination or individually prepared me to become a government worker. Because if I'm paying 50% of my income to the government, essentially I'm a government worker, but I never studied to become that. So I don't think so. I think if I pay half of my income, and I'm not complaining about it, to the government, what becomes a fair share? Should I pay 70% of my income and then hire fewer people and support the economy locally and nationally less? So that's what I mean. There's so many variables that are involved here. And I don't want to talk about politics, but generally speaking, whatever side of a political spectrum one is on, all of these conversations, I think, relating to what you talked about, are politically motivated more than anything, in my
Yeah,
view.
and the reason for why I asked the question is twofold, and nothing to do with politics. The first part is some information or some prediction based in wishful thinking. And then the other aspect goes to the behavior component of generating envy. So I believe from what you said, anybody who is putting out budget projections, like the government does, and says, okay, because we doing this and this and this in the area of taxation, we are predicting that all these wealthy people now are going to generate hundreds of billions of more taxation just because we're looking closer to their tax returns. In my opinion, is ludicrous, because those are by far the people who can pay $50,000 or $100,000 a year just to get their taxes done properly, right? So
Yeah,
that
I agree. I mean, unless somebody's cheating, and I deal with a lot of wealthy families over the years. Most of the people I deal with, I've never come across somebody who's looking to cheat. They actually go out of their way to try to do whatever they can to make sure everything's done
exactly. Yeah,
properly,
yeah, yeah.
right? Saying so, the fact that there are tax deductions that certain people are entitled to is not cheating. And that's not how they got their wealth. That because they have their wealth, maybe these people are giving money to charity each year,
Yeah,
and they're allowed to take a tax deduction for that. If they didn't have the wealth, neither the charity would benefit nor would the client get the tax deduction. So, it's just one example, but I think a lot of times these things are looked at asymmetrically. But to your point, people, envy is worse than greed, and it can lead to a lot of conclusions and narratives to justify the feeling of envy that you have, right?
yeah, absolutely. I mean, it can go pretty far, I believe, if people get riled up enough, with the wrong arguments being made.
Sure.
I mentioned that I have one or two questions I ask everybody at the end of the show. So the first one would be, if you could meet anybody dead or alive, who would it be and why?
I'd probably love to meet Frank Sinatra. I was always a big fan of the music back then, the standards, but also he was this persona where he just seemed to always know the right place to be at, the right things to say, and charisma. Love to have met him and gotten to know the real person behind him.
Yeah, that's very cool. And then the last and second question I always ask at the end of, if you have the time, is, if you had a time machine, where would you go and why?
I think it's related. I'd go back to the 50s and 60s because I'm an old soul. And back then, not only because I loved that whole era, I'd love to grow up with characters, whether it was Frank Sinatra, Jackie Gleason, all those kind of people. But also from what I do for a living, I know back in those days, like in the 60s, if you talk to someone today, a grandparent who lived in those, they would say they're nostalgic for those days. The 50s and 60s were the best of times. Everybody had a great middle class job, everyone had a great middle class house, and the best of times. What I've learned is it wasn't necessarily the best of times. If you go back, I always say when you talk about happiness, it's an equation. It's my results today minus my expectations. And that has to be a positive number if you're ever going to be happy. Because if your expectations keep moving like the goalpost, you'll never be happy. Your results will never be good enough. And so, from a societal standpoint back then, for example, average house size was 900 and some odd square feet. Today, it's 2,300. So, if we look at our incomes back then, the average family income went from 30,000 today to about 70,000 after inflation. Our income's more than doubled, but people don't feel happier because their expectations more than doubled. The house size went from 900 to 2,300. And so I would love to have now go back and live through those times and really examine people's happiness and see how they kind of behave relative to all of those things that I just talked about.
It's absolutely fascinating. I mean, I have the good fortune to be able to talk to my mom about this kind of stuff, and she was basically like really getting into the workforce and kind of blossoming and stuff, and was one of the kind of early women that actually got jobs, and my dad had a job and stuff. And when I talk to her, one thing I find interesting that she always points out is this kind of like almost tangible feeling of positive energy and opportunity.
Right.
And,
yeah. Well,
you know, and if you think about it, especially since that was in Germany, right? Like, so the war was over for like 15 or 20 years. And it wasn't normal that a normal person without a rich background or stuff like that could go to work, have an income, have 2 kids, with a car they owned, with a camper and stuff like that, and spend 4 weeks at the beach, right? And when I talk to her now, she says, you know, I'm retired now and I'm old, and I feel that so many people are so afraid of what they can do every day because they don't feel this energy of opportunity anymore.
Right. Well, you know, when you talk about that, I think there's a human nature propensity for pessimism. We seem to love pessimism. And there was a fellow, I'll leave you with this thought, in 1835, he was the British Undersecretary of War. His name was Thomas Babington Macaulay. And back then he said, we can't prove those wrong who tell us that we're at some turning point, that the best days are behind us. Nor can we prove those wrong who tell us the same today for just as much apparent reason. And then he says, on what principle is it that when there's nothing but advancement behind us, we're to expect nothing but deterioration before us? And he said that almost, 200 years ago. So the point is that stuff never goes away. And it's unfortunate, but our kids go on a school bus today, middle-aged kids with this device. They carry more computing power than NASA had for Apollo 13's rescue mission in this one device.
Yeah,
and,
absolutely.
I call it the commoditization of miracles. You know, we're living into our 90s today. 300,000 people are gaining access to clean water every day. Poverty and illiteracy are almost eradicated. They were 50% 50 years ago of the population. So, you could go on and on, but when you watch the news, they don't report any of those things. They'll report about the plane crash. They don't report about the thousands of planes that took off successfully and landed successfully. So in our mind, oh my God, it's dangerous to fly.
Even if the thing didn't crash and just the door fell out or something like that.
Right, that's it. So unfortunately, that's just the way things are, human nature-wise. Most people tend to be more and also pessimism is much more compelling than optimism. Optimism sounds like a sales pitch. Pessimism sounds like someone's trying to help you. Oh my God, this is happening. Let me tell you what you got to do.
Yeah, absolutely. So if people say, wow, this Jonathan guy with his knowledge and human behavior and investing and finance, I want to kind of get in touch with him. I want to kind of learn from him. How can they do that?
Thank you. Yeah, so easiest thing to do, I guess, is go to my website, fusionfamilywealth.com, and all my information is on there in terms of phone numbers, contact, our insights, articles, and previews, all that kind of stuff. All will be coming out with our own podcast called Crazy Wealthy, so they can be on the lookout for it.
Yeah, okay, that's cool. So fusionfamilywealth.com, that's the first thing that we're going to put underneath the show so people can easily find it. Jonathan, I want to thank you. It's such a fascinating way to talk to you and be able to ask some questions, and I rarely have an opportunity, so thank you for making the time.
Oh, pleasure. Really nice to get to meet you.